Hello.
Hi Sylvia, how are you?
Hi, Aseem. Sorry for the confusion on the invite link.
No, no problem.
Yeah, so today I don't think we'll have an audience. We'll just do a pre-recorded one and then my trading community will access it from the YouTube channel once it's posted tomorrow.
Sure, sure, yeah.
Yeah, I had already done your trading bio, so I think we can just dive right into the questions. But before that, I'd like to know a little bit about you. It's the first time we're having you on our trading lounge. So maybe you can briefly tell me who you are.
Sure.
Yeah.
Right. So I've been in the markets for almost maybe about 8 to 9 years. I've been trading. I've been in the financial domain for almost 15 years. My first job, in fact, was at Deutsche Bank Singapore. So I was in the middle office in investment banking. I was
Mhm.
there for almost 3 years. And after that, once I came back to India after my MBA, I started my own fund. So I am predominantly an options trader. So I trade options, and I do algo trading. That means everything is fully rule based. Everything is fully coded. I don't take any manual trades. Everything is um, completely automated. And I've been doing it, like I said, for the last 7, 8 years. Apart from that, I teach students about algo trading. So I've taught probably more than 4,000 students till now,
Mhm.
where I teach them how to create their own strategies using Python. And apart from that, I'm also visiting faculty in one of the universities. So I teach finance and algo trading in one of the universities here.
That's a busy, you really have like a busy schedule in terms of your career. All right.
Yes,
So today we'll get more acquainted with your work and yeah, I think I knew you from professor from the World Quant University. Maybe you can just, since you're an algo trader, today we're going to focus more on day trading and algo trading, quantitative trading, basically what you do. Maybe you can tell us, because you've traded for institutions before, how has that journey been, trading for institutions as well as trading for your own trading account? When it comes to your trading experience.
sure, sure. Yeah. So I think we met via Professor Rito
Yeah.
um, from World Quant University. So, I mean, I have always been an options trader. So that's my forte, and been, I've never traded anything apart from options. Even
Mhm.
in options trading, my portfolio, I would say 90% of it is actually intraday trading. So in India, when we talk about intraday trading, the timing is till 3:30. So it's only a 6 hour session from 9:15 to 3:30, and that's when we trade. um, the kind of strategies that you trade, let's say on a personal basis compared to on an institutional basis, can be very different. Because on a personal account, since you are trading, let's say on a smaller capital, um, probably let's say $500,000, which is still sizable, but in a grand scheme of things, it's a smaller capital. So the kind of strategy that you are doing is very different, because the amount of slippage that you will get on this kind of a capital is not going to be too large. But let's say if you try to do the same strategies on a capital, let's say $10 million, they will not work out. So usually what I've seen is on bigger capitals, we tend to go for trades or strategies where there are not too much churning happening. So I would prefer
Mhm.
a strategy. Let's say I don't have to take too many trades, probably 3 to 4 trades in a week. That's what will be my let's say the sweet spot. But on an
Mhm.
intraday basis, even if I can get maybe about 3 trades on per strategy basis, I can still make profits. And I've always been an option writer. So when we talk about option writing, we get benefit of theta decay. So the idea is that not only are we making money because of the direction, which is because of the delta, but I'm also making profits even if the markets do not move, and I get the theta benefit. So the good part about trading in India is that we have something called weekly expiry. So
Weekly what?
we have weekly expiry.
Ah, okay.
So basically, our options they get expired every week.
Mm-hmm.
That means the theta is pretty good there. And if the markets do not move, let's say, okay, so right now is different because of the Trump
Mm-hmm.
all the changes that he's doing. But let's say in a normal scenario, if the markets don't go more than 2% up or down, you end up making profits. So there is a lot of theta. There's a lot of, I would say, low-hanging fruits for someone who wants to do option writing in India. But obviously, risk management is very important.
Yeah. And now, because you're an expert on options day trading yourself, maybe you can tell us, because most of us are really new into options trading, maybe you can tell us the difference between call and put options, and then we can continue.
Right. So the first difference obviously is that a call option essentially is when you have a positive outlook. So let's say if you feel that the market is going to go up, you would go up and buy a call option. On the other hand, if you feel that the market is going to go down, you would go ahead and buy a put option. But that does not mean that buying a call is equal to selling a put, or buying a
Mm.
put is equal to a selling a call. So the reason is because options are non-linear. That means that let's say if I buy a call option for $50, it has the potential to go up from $50 to even $200.
Mhm.
But it cannot go down below $0. That means I have an unlimited upside potential, but I have a fixed loss in this example, right? So um, a call option buying is not same as put option selling. Um, Obviously it will look like if buying option is so good because I am making unlimited profits, but my losses are going to be limited, everyone should be buying options, whether a call option or a put option. But the major difference comes in the probability. So
Mm.
there is something called theta decay in options. That means, let's say you feel that let's say the price of the underlying is at $50. You feel that the market is going to go up, and you purchased a call option of strike price 50. And one day passed, the market was very, let's say, sluggish. It went up by a couple of dollars, came down by a couple of dollars, and ended up at 50 only after, let's say, few hours. Now, since you have bought call, let's say you bought the call for $10, what will happen at the end of the day? You will end up losing money, not the entire amount, but probably that $10 will reduce to $8.
Mhm.
So that is because of the probability, or what is called the theta decay. So the option writers where they make money is when the markets are not going in any particular direction. When the markets are sideways, that's when you end up making money. So it really depends on what kind of a trader you are, right? If you are someone who's extremely good at finding out directions, you would end up doing option buying strategies. But if you're someone who can hold on to your trades, so because that's also an art, not everyone
Mhm.
can hold on to their trades for, let's say, 6 hours, right?
Yeah.
So if you are someone who can hold on to your trades for a long time, and obviously to do that, you need to be very strong in your risk management. Then option selling is definitely a better alternative. So, like I said, I've always been an option writer, and even with option writing, I prefer direction strategies. That means, let's say, if I feel that the market is going to go up, what I would do is I would short a put option. Because let's say even if I'm wrong, even if the market does not go up, I still end up making profits. So that's the general thought process. Like I said, I don't mind holding trades. So a lot of times I might have taken a trade at 9:20 in the morning when markets open, and I will square off at 3:20. So 6 hours I will be in the trade, and I will be very chilled out. I will not keep looking at my positions, whether I'm making a profit or I'm making a loss. So that's very important if you're an option writer.
Mm. All right. And you talked about risk management. I don't know if you're able to, I'm gonna give you access to share screen just now. I don't know if you're able to maybe take us through a live trade setup, maybe a recent trade setup for your options trading, and then we could see how you actually put up your risk management tools.
Sure, so give me a minute. Let me just open up.
Yeah. So, and then also you mentioned that you're a trainer, basically in and running a education faculty. So maybe you can explain to us as you're opening the role of AI and Chat GPT for modern day students who are interested in financial markets.
Sure, sure. So yeah, I'll talk about that first. So ChatGPT or any of these LLM models, they are good for someone who's beginning to trade because it will give you a lot of understanding. The basics, like you said, right? A call option, a put option, what is the strike price, what is VIX, what is gamma, what is theta, all those basic understanding you can get very easily. You don't really have to dig through a lot of online data, and it gives you ready-made answers. But I've seen a lot of people trying to find strategies, or let's say trying to get recommendations from
Mhm.
ChatGPT. That is not going to work out. So if I ask ChatGPT, tell me a good strategy which works on S&P 500, it will not be able to give you that, right? So there are obviously limitations. Also, when I use the word AI or when I use the word machine learning, firstly, AI is different, machine learning is different. So again, a lot of people
Mhm.
have confusion between AI and ML. So we'll talk about machine learning. Machine learning is essentially we are feeding in data, we are feeding in the prices of any symbol, and we are trying to predict some kind of patterns,
Yeah.
right? Now, markets are very noisy, and they usually follow random walk theory. That
Mhm.
means if I do a coin toss and if I get a head, that head has no bearing on the next coin toss, right? That's a general meaning of a random walk theory. So what that essentially means that if let's say today is a green day, I mean there is no guarantee that tomorrow is going to be a green day. So machine learning on a larger time frame is not that useful. Machine learning where it actually helps you is on a very short time, in a very small time frame, something like an HFT trader, right? So if you're an HFT trader, high frequency trader, that is where the actual momentum, because there are a lot of research that has proven that momentum is an anomaly. Momentum is an anomaly for random walk theory, but that is usually on a very small time frame, on an HFT time frame. But HFT trading we can't do as a retail trader. You and I, we can't do HFT trading because the software required, the infrastructure, the hardware, the servers are extremely expensive. So at a retail trader perspective, I don't think currently we have any good sophisticated tools which can help machine learning bring us profits. It will probably be more like technical analysis, fundamental analysis, but then we are talking about markets being whether they are semi-form efficient, weak form efficient. That's the idea. I think that still works, but I don't think ML currently works. As per me, I have not found any great machine learning strategies which are giving me alpha.
All right.
So yeah, let me quickly share the screen. I can share the screen now.
All right.
Does it say? Okay, I'll have to remove this. Um, I hope the screen is visible.
Mhm.
Okay, so I am personally a price action trader. That means
Mhm.
I don't like using indicators. So personally, I don't like them. But just to give an example of what is risk management, I'll use an indicator. So I'm using a very simple indicator. So this is Nifty. This is the index in India, and I am using 10 moving average, and I'm showing you a 5 minute time frame, so an intraday time frame. Now, how I would trade market, let's say if I'm using an indicator, and let's say we are doing a very simple strategy where we are saying that if the market goes above the moving average, I will I will go long. Let's say we have that strategy, right?
Mhm.
So like I said, but if I am trading that strategy, I would rather trade it as an option selling strategy. So if we take an example here, let's take an example of this candle, right? So this green candle, it broke above this moving average. That means when the candle closes, I would be shorting a put option. Now, usually, since I know that I will be in the trade for long and I'm doing a directional trading. So since I'm playing for a direction, I don't like selling cheap options. I don't like selling out of the money options. My preferable options are usually at the money because that has the highest theta decay. So I would look at what is the at the money price. And in this case, the actual price is 20 to 380. That means my strike price is going to be 20 to 400 call. So what I will do is I will take the trigger from the spot chart, but I will actually go ahead and take the trade in the options chart. So I'll show you the 20 to 400 put now. So again, I'm showing you the current expiry, which is the 17th April, and 20 to 400 put. So this is the price, and let me show you the 5-minute chart. So how my algo would work is that as soon as it gets the signal from the spot chart, which is at 10, the closing of 10:50, it will automatically jump to the options and it will find out that 10:50, which is here. So as you can see, this is the candle of put options, and it will sell that put option, and the price is around 309. So my selling price becomes 309. So I'll keep writing it here. So 20 to 400 put. I've shorted it at 309. So this is my selling price. Now, obviously, I have to put a stop loss. Now, multiple ways to put stop loss, right? So you can put based on swings, you can put based on volatility, you can put based on your percentage basis. But let's take a good method, which is usually the swing method that I personally like. So when I trade this here, the swing low is the low of this candle, the low of 1045. But since I am trading in put options, it will become the 1045 candle high. So whatever is the high of 1045, this candle high, that will become my stop loss. So in this case, this is 371.95 or 372. So I've got my stop loss also from the options. So my stop loss is 372. Now, again, right now, this is looking like a very big number. As you can see, I have a risk of almost 60 points. But this is because of the high volatility, because of all this tariff news.
Yeah.
Okay, so I've got my stop loss. Now, when I'm selling options, usually I don't like to put any targets. That's how I trade. I like to keep trailing my stop losses because I know anyway I'm going to make money even if the markets are not moving. So I don't like putting targets. But my position sizing is very important. So let us say I'm trading with, so I'll be using rupees here. So that, so let's say my capital is 100,000. So that's my capital, 100,000 rupees. And let's take an example that on a particular trade, I want to risk 5%. So that's my risk appetite. Again, this is a big number, but I just want to give an example. So let's say my risk appetite is 5%. That means I don't mind losing about 5,000 rupees on a single trade. Okay. So I can easily find out what is going to be my quantity. So my risk is 372 minus 309, which is 63 points. So my quantity is going to be 5,000 divided by 63, which is about 79. So I will trade this. I will trade this with 79 quantity because even if I go wrong, my maximum risk is 5,000. So I already know that, okay, this is the risk that I'm willing to take. So I'm very clear. Like I'm not in any, during the trade, I am not getting too hyper even if the market reverses and hits my stop loss. So so I've taken all this. Let's go forward. So once I've done that, now I am not going to use this anymore. I'm not going to use it anymore because the spot is only going to help me to go for the entries. Once it has given me the entry, all I'm looking for is this chart. And like I said, I'm going to keep trailing my stop loss. Now, how do I trail it? Initially, I have taken the entry at where was the candle? At this candle, right? We had taken the entry here. This is where we had sold the option. and we've put the stop loss here. Now, what I am looking for is I'm looking for the market to take a reversal, which is like this, and continue its journey on the downward side. So as you can see, it continues on the downward side. Once that happens, my stop loss will shift from here to the second peak, which is here. So my stop loss has reduced to about 360 now. So my trailing stop loss, so now we have a trailing and it has now reduced to 360. That means my maximum loss cannot be 5,000 anymore. My maximum loss is 79 multiplied by whatever is the risk, about 50 points, about 4,000 rupees. So I know that my maximum risk has reduced from 5,000 rupees to 4,000 rupees. And I want to keep trailing it as much as possible. So again, I will look at here. You can see market went up, continue down, right? And again, I'm just checking the put option. So it went up, continued to go down. So I'm going to shift my stop loss from here all the way till this peak. So this becomes my new stop loss. This becomes my new stop loss, and which is 247. So my new stop loss is 247. And what happens? It goes up and hits it. So my stop loss got hit at around 135. So I was in the trade since 10:50 to 1:35. That's almost 2.5 hours, right? So I was in the trade for 2.5 hours, and I ended up making a profit. So what is my total profit? My total profit is my entry minus my exit, about 62 points. So we made about 62 points. And if you see here, we ended up making a 1:1 risk to reward because we started with 63-point risk. We ended up making 62-point profit.
Yeah.
So it was a good trade. It was a good trade. Now, let's check what would have happened if we would have taken the same trade as an option buyer. Let's do that quick check, right? So rather than shorting a put option, let's say I had bought a call option. Same thing, same example. So I'm going to just change to 22,400 call option now. And let's do the same analysis. So we are taking the entry at 10:50, which is here at about 342, right?
Yeah.
So taking the entry at 342, keeping a stop loss of 285. So 342 and 285. And again, what is my risk? Almost similar, as you can see, almost similar. And it gets executed here. This is where it executes, which is about 475. 475. So my net profit in this case would have been about 100 points, about 133 points in fact. So first, like I said, right, I was telling you that shorting a put option is not same as buying a call option. And this example is clearly showing that as an option writer, I made a profit of 62, whereas as an option buyer, I made a profit of 133, which is almost double, even though Nifty moved the same amount. Right? Now, you must be wondering why this happened. So usually, right, usually the case is opposite. As an option writer, I will end up making more profits than option buying. But the reason why this is happening is what is called VIX. So if you go to VIX here, which is your volatility index, currently the VIX is extremely high. If you notice here, our VIX is currently at 21, which is fairly high, because if you look at the normal VIX here, we were languishing at somewhere around 14 till a couple of days back, and suddenly it's at 21. It's a huge move, right? It's a huge move. So most of this profit has actually come because of what is the Vega, right? It has come actually for the Vega, the movement because of the volatility or the IV. So like I said, this is something which is not that common, right? Not that common, because as you can see, usually the VIX does not move so much. Usually the VIX is very stable, but just because in this example, there was a high VIX increase, that is why you can see this kind of a change in profits. Usually it will be the other way around. So let's say 90 out of 100 days, an option writer would have made more profits than an option buyer.
All right. I think we'll need more sessions with you to just understand everything about what you've just discussed. But I think I've gotten a bit about your trading rationale and how you put your stops, how you trail your stops. Um, yeah, so maybe you can also explain to us, because I see that you're an author of 51, the name of your book is 51 Trading Strategies. So if people were to buy your book, I know it's on Amazon, what would they expect? Is it like an options, like these 51 trading strategies? Is it from your trading journey, or is it, maybe explain to us what that book is all about?
Right. So I wrote this book almost a year back. It's been an Amazon bestseller. So it has a combination of a lot of strategies, not just options. Because like I said, right, I teach a lot of students, and not everyone wants to go into options because obviously options is something which is very risky also, super leveraged, right? And at least the numbers say that 90% traders in options end up losing money. So it is not that everyone wants to do that. So this book was more from what I've learned so far from different traders. So again, it's a small community. Most of the good traders, we know each other and we know what kind of ideas that they have. So this has a combination of a lot of strategies that I don't even trade, but I know that those are good strategies which are traded by good traders. So it has a combination of intraday strategies, equity strategies, long-term investment ideas, a lot of back-tested strategies. So I think about 8 strategies on options which have been back-tested. That means I've already given about 6 or 7 years of data. Strategies on price action, strategies on indicators, strategies based on, let's say, just numbers, just premiums. So it's a combination of different ideas because every trader is different, right? So the
Yeah.
idea of the book was that, let's say, you are a trader who likes indicators. You will find at least 6 strategies on indicators. You are a person who doesn't like indicators, who only likes price action. You'll find those also. So it's a combination of different ideas. And like I said, a lot of strategies I don't even trade. It's just that what I've learned through other traders.
All right. And then at some point during your career, you actually ran, you previously worked as a fund manager, and then you also ran a family office. So how different is it when you're managing money for other people and when you're trading your own account?
Very different, right? Because when I have my own account, I can take more risk, to be very frank. It's my own money. The risk appetite is much higher, right? When you are trading for someone else, so we were doing it through a fund, it was a startup, then the risk appetite is very different. So every I would say every trader has a set idea, right? So like I said, I like only options. That's what I like to do, and inherently they are risky. So imagine someone who only likes to do equity trading. Then I mean I cannot help him because that's not my cup of tea. I can obviously give him ideas, I can obviously give him some strategies, but will I be as confident as I am with options? That's not the case. So I would say it's always trading on your own account is definitely easier. You have the full control. You have full control on your emotions also, because when you're trading, let's say for on a funded capital, then the the emotions also play a bigger role. Plus you are trading on a larger capital also, so then human emotions will come into the picture. Even though everything is automated, still at the back of your mind, okay, a 1 point loss is about, I don't know, $100,000 loss, so that's a big risk that you're taking.
Yeah. And then for options trading, do people need like a high amount of capital to start? And
uh,
how is that like when people are trading options?
yes. Yes. So let's say if you're trading index, the one that I just showed you, Nifty,
Hmm.
um, we have something called lot sizes in India. Lot size means that the minimum quantity that I can purchase in an option or sell in an option. So they keep changing, the lot size keep changing, and the current lot size of Nifty is about 75. So what inherently means is that if you're an option writer, the as per the regulations, you require, let's say, minimum of 1.5 lakh rupees. Now, 1.5 lakhs is a considerable amount. It's about maybe about $2,000. So that's the minimum amount that you need to trade options for one lot. That's the minimum. A lot of traders actually prefer option buying because the amount required is very low. So the
Mm-hmm.
same thing if I'm doing option buying can be done, let's say, with even $50. So it's a huge difference. It's a huge difference, but then the risk management is something that they forget because they are doing extra leverage,
Mm-hmm.
and even one trade can wipe the entire account. So if you ask me, if you are following correct risk management principles, minimum, at least in India, should be about $2,000 for one lot of trade.
Pretty capital intensive. Um,
Yeah.
yeah. All right. So before we conclude, what can you tell us about with algo trading? Do you always backtest your strategy? Do you usually tweak it to, especially now that there's a very dynamic market conditions, increased volatility with the tariffs in US, China, and everything with the trade wars? Or is your strategy just automated and it's a plug and play kind of system?
So usually, any strategy that I would run will be backtested. So I have a complete team. We keep backtesting different strategies. Usually I prefer to have three kinds of strategies. One is what is more like a breakout strategy, the one that I just showed you, where I'm playing for the direction also. So I'm trying to predict the direction. I'm playing for the direction. Obviously, I'm trying to make theta also because I'm shorting an option. The second strategy is more of a mean reversion, where I am, let's say, shorting both call and put together. And
Mhm.
I'm expecting the market to not go in any direction. It will remain sideways, probably volatile, but remaining sideways for the entire day. And the third one is which is very adaptive because even in a single day, market can go up, suddenly reverse and come down, right? So it's more of an adaptive strategy where it will dynamically keep finding out what is the current direction of the market and try to play in that particular direction. So those are the three kinds of strategy that I usually deploy on my account. Now each strategy is at least backtested for 5 to 6 years. And if all of them are giving me a good calmar, a positive expectancy, then adding all of them together will actually end up giving me even a better calmar because the drawdowns will reduce. Because when, let's say, trending strategy is on a drawdown, that means the sideways strategy is definitely making money. So my net drawdown will reduce, and which will end up giving me a better calmar. So yes, backtesting is a must for us. Once we are backtested, then it's just automating it fully. So during market hours, I don't even look at the charts, or I don't even look at the positions.
Mhm.
It keeps running automatically. All I know is that even if everything goes bad, right, I will end up losing, let's say, 0.5% or 1% of my entire capital. So that's the position sizing or the risk management is already built in. So since I already have that in at the back of my mind that okay, that's the worst case loss in a particular day, I am fairly okay with trading. The problem comes when your risk management is not correct, right? If
Yeah.
let's say you are either making 10% in a day or losing 10% in a day, right? That's when the heartbeat goes up and down. But if you're trading on a large enough capital where you can only lose 1%, you can only win 2%. It's more stable, and you can play the game for a long time.
All right. Thank you so much for your time. Maybe as we go, you can tell people where they can find you. I know you have a YouTube channel, but I think it's in India. Could you have like an auto translator to English, or just it's just a request so that we can also understand your tutorials? Because I see you've grown it to almost 400K subscribers. That's pretty impressive. And
Uh,
maybe you would have more followers from other regions as well.
right. So the videos that I make for that portal or that channel is Hindi.
Mhm.
So most of the traders who come through YouTube are Hindi speaking. I do have a personal YouTube channel also by the name of Aseem Singhal. and there I have put videos on in both Hindi and English. There are a lot of videos actually on how to use Python and machine learning concepts to test and backtest strategies. So that's a little technical part as well. Apart from that, I'm always available on LinkedIn. People can drop me a message. I usually respond to everyone. I am also in right now in the process of opening a firm in Dubai where I will be doing crypto arbitrage. So
Mm-hmm.
arbitrage between different crypto exchanges.
Mm.
And I have a startup called Unfluke, where they're trying to give a portal where people can backtest strategies just by putting it on a chatbot. So, for example, they have a strategy: I want to buy S&P 500 if today's opening price is more than yesterday's closing price. Tell me the result for last 5 years. A very simple sentence, and it will tell you each trade that has happened in the last 5 years. But not for US markets. Again, it's going to be for the Indian markets as of now. We are trying to expand that to global markets also soon.
Okay. All right. So I think we'll have to book you again for an options 101 class because I think this is the first time we're like hosting an options trader on our trading lounge, and you have a very easy way of explaining things. I think that's why you're a tutor. Yeah, so it's truly an honor to have you. I think you will send me the links to your YouTube channel, the one that's separate, the one that's not Indian following, and then I will link it on the show notes. And also, I think you don't have a website yet, but I think I can put in your LinkedIn handle just for people if they
Sure.
will reach out to you. Yeah. So thank you so much. That was nice. I was in class. I've learned a lot, and pleasure to have you. And I'm hoping to have you again on our trading launch. Aseem. Thank you so much.
Sure. Thank you. Thank you, Sylvia. Have a good one. Bye.
All right. Cheers. Bye.